The Federal Reserve. It's probably the most powerful financial institution on the entire planet. And right now, it's caught in this incredible fight. A debate not just about what it's doing, but about whether it should even exist.
So that brings up a wild question, right? Could the U.S. actually scrap the Federal Reserve? I mean, what would that even do to the economy? It sounds totally out there, but believe it or not, people are seriously talking about this.
And to get a sense of just how radical this idea is, get this. There are only 2 countries on Earth with their own currency that don't have a central bank. Just 2. The reality is, pretty much every modern economy has a central bank. And there's a really good reason for that.
So to really understand why getting rid of the Fed is such a huge deal, we've got to go back in time. You have to ask, why was this thing even created in the first place? Well, it turns out it was an answer to total, complete chaos. See, for a huge chunk of the 1800s, the U.S. didn't have a central bank. And honestly, it was the Wild West. I mean, every little bank was printing its own money. You can imagine the forgeries. It was a mess. This all exploded in 1907 with a massive bank panic that brought the entire system to the brink of collapse.
So when the Federal Reserve was finally born in 1913, it had one really simple job: be the lender of last resort. Basically, if banks started failing and people were panicking, the Fed would be there to provide cash and stop the whole house of cards from tumbling down. That was its whole purpose.
But you know how things go. Over the years, that simple job got a lot more complicated. Today, the Fed's mission is way bigger. Now it's supposed to manage the entire U.S. economy with just a couple of levers at its disposal.
And since 1977, Congress has given the Fed what's called the dual mandate. Think of it as its 2 big commandments. 1, keep prices stable. That means keeping inflation in check. And 2, keep unemployment low. It's this constant, tricky balancing act.
So how in the world do they pull that off? The easiest way to think about it is like driving a car. The Fed's main tool is the brake pedal, interest rates. If the economy is running too hot and inflation is a problem, they raise rates. Borrowing gets expensive and people spend less. The gas pedal, that's what we call open market operations. It's basically them pumping money into the system to get things moving again.
Now, here's the catch. You and I, we don't get our loans from the Fed. It works more like a chain reaction. The Fed changes the rate it charges banks. Then, your bank turns around and changes the rate on your mortgage or your car loan or your credit card. That, in turn, changes how we all spend our money, which affects the whole economy. And then, finally, prices start to move. It's a pretty indirect process.
Okay, and this is where the real debate about the Fed kicks into high gear. Because our economy today looks nothing like it did decades ago. And these old tools, well, they're being used to fight brand new kinds of problems they were never really built for.
A huge one is inequality. Think about it. When the Fed flooded the system with cash after the pandemic, a ton of that money went into assets, stocks, real estate. So people who already own those things got a lot richer. But now the Fed is raising interest rates to pull that money back out. And who gets squeezed the hardest? It's the households carrying debt, trying to make ends meet.
And it gets even weirder. The Nobel-winning economist Joseph Stiglitz points out something that sounds completely backward. Sometimes, raising interest rates can actually cause inflation. I mean, if a business's loan payments or rent goes up, what do? They might have to raise their prices to cover it. And boom, that's inflation. It can become this crazy, self-defeating cycle. And that leads us to maybe the biggest problem of all for the Fed right now. It's not just that driving the car is hard, it's that there's someone else in the passenger seat grabbing for the steering wheel.
Let's go back to that car analogy. You've got the Fed in the driver's seat with its foot firmly on the brake, trying to slow down inflation. But at the exact same time, you have the government stomping on the gas pedal, trying to boost growth with big spending programs or tax cuts. They're literally pulling the economy in opposite directions. And that kind of tug of war is a massive threat to the Fed's independence.
So, where does that leave us? Let's go all the way back to the beginning. With all these new challenges and all this political pressure, could the Fed actually go away? What's the bottom line here? Well, technically, yeah, it could. You could just roll its duties into the Treasury Department, but here's the giant red flag: discipline. History teaches us a very clear lesson. When politicians get their hands on the money printer, they tend to think about the next election, not the next decade. Short-term popularity almost always wins out over long-term economic health.
And if you want a perfect real-world cautionary tale, you just have to look at Turkey. Their president decided he wanted low interest rates to juice the economy, period.
and any central banker who disagreed with him, fired. The result was completely predictable: runaway hyperinflation and an economic meltdown that they're still struggling to clean up. It is a textbook example of what happens when politics completely takes over a central bank.
So you see, this whole fight over the Fed, it's about so much more than just interest rates. It's really about a battle over independence, over discipline, and ultimately over control of the economy. And it leaves us with this one massive question. When the short-term demands of politics go head-to-head with the long-term health of the economy, which one gives way first?